Welcome to the Rain or Shine podcast, where we talk about all things PRF. My name is Ross Bronson. I'm the Ag Risk Consultant with Red Summit Advisors. And today I want to talk to you about your policy is self-funding. What does that mean, right? So we say that a lot. I'm assuming other people hear that a lot too, that your PRF policy is self-funding. And on the surface level, what that means is that any indemnities that you receive will go towards your premium first, and that there's no upfront out-of-pocket cost. So if your auto policy was the same way, then basically you would never pay a premium for your car on every month, but that as you got in car accidents, the money that was given to you for your car, your $5,000, would pay for your premium first, and then the rest would go toward you being able to use for whatever you needed to for a new car. So that's just a simple example of how this works. Your indemnities are calculated based off of fixed rates for your county-based value from the RMA. And as your precipitation drops below your 70-year average for your grid and interval, which if you want to know a little more about those, we have another video that dives into those deeper, then it does what's called triggering an indemnity. So payments start happening. And as those indemnities or payments are triggered, then you won't see any money at first because it will start going toward your premium. So again, with the car example, if your premium's $200 and you get an fender bender and the cost is $100, they're gonna pay the $100 first, and you'll still have $100 left on your premium. So what happens is over time, depending on your landscape and your precipitation, that premium gets whittled down. And then it gets to the point where your premium is paid in full and you start receiving checks. So if you are receiving funds in the form of check or direct deposit from your AIP, your insurance provider, then your premium, has been paid in full and you don't owe any premium. And those funds are for you to use however you see fit. And the thought process there is if your precipitation is below your 70-year average, then you clearly have some additional cost in the way of forages or some things like that need addressed. And that's what those funds are for. However, nobody checks up on that. You can use those for whatever you feel is best. Now, what happens if at the end of the year, your indemnities, your precipitation hasn't been low enough to pay your premium? Well, at that point, clearly you're going to be responsible for your remaining balance. The important thing here in this conversation is to note that it's very, very unlikely that you will ever owe your whole premium amount. So you may see $10,000, $5,000 as your premium. Most often, at least a portion of that will be covered through the indemnities throughout the year. So that's important. But let's say at the end of the year, you do get to a point where you owe. There are some options here. A lot of people that have gone and picked a policy that fits with their risk tolerance will pay it in full, either through cash, or we have some folks that use their operating line of credit to pay that. The other option is the insurance providers, your AIPs will provide a payment plan option, and the terms of that just depends on your AIP. Those do have some interest charges associated with them, but oftentimes what that helps do is put off payments a little bit while those later intervals of the year are verified and those indemnities are triggered. And quite often, if you're on a payment plan, by the time your first or second or third payment roll around, there's less premium even owed than when you first entered into the payment plan. And naturally, that just depends on your policy. But the risk of owing your premium is clearly something a lot of people are concerned about. And really, that just depends on how aggressive your policy is built. We talk a lot about the differences in policies from one insurance agent to another, often just depend on how coverage is allocated. We try to have conversations with our producers about what their risk tolerance is, how much premium can they afford, are you more interested in higher payouts, and we design a policy that way. And so naturally, if your policy is more designed for higher indemnities, higher payments to you, it's going to be a riskier policy, and the risk of you owing part of your premium is a little bit higher versus a more conservative option. But that's all stuff that can be discussed with your insurance agent as you analyze the data of your operation and allocate coverage. You can help dictate how much coverage you want, what your premium is that you're comfortable with. And as we do that, then we can also show you over the last 20 years or 15 years, if your policy had been allocated and designed in that way, on average, how many years you would have owed a premium, or how many years you would have gotten an indemnity, and what those average premium owed and indemnity amounts are. And so at Red Summit Advisors, we really love to go into it, providing you as much information as we can to be able to make a really educated decision for your policy. But that's what it means by PRF insurance is self-funding. You don't owe any premium out of pocket. You only owe a premium at the end of the year if your policy hasn't triggered enough indemnity to pay it in full by that point.